This is the United States in 2011. Millions of people have lost their homes, and millions more are in the process of foreclosure. Businesses across the country have shut their doors. The economy is sluggish, and unemployment hovers near 9%. How did we get here? Many of our current woes are the result of the banking crisis of 2008. This was the worst financial crisis since the Great Depression of the 1930s. Several major banks and Wall Street firms collapsed, and markets plummeted around the world, leading to a global recession. In 2010, the Congressional Financial Crisis Inquiry Commission concluded that the crisis was avoidable. It identified several causes of the crisis, including failures in financial regulation, reckless behavior by financial firms, excessive borrowing by households in Wall Street, a lack of accountability and ethics at all levels. Here's how it happened. In 2000, the tech stock bubble burst, causing a huge decline in the stock market. Unfortunately, the dot-com crash was accompanied by disclosures of financial fraud at companies such as WorldCom, Enron, Global Crossing, and Tyco. The government wanted to keep people spending to head off an economic slowdown. In order to promote spending, the Federal Reserve lowered interest rates from 6.5% to 1%. This made credit inexpensive, so consumers borrowed money, from credit cards to home loans. By the end of 2007, household debt was 127% of disposable income. Much of that debt was from home mortgages. The housing boom was the biggest financial bubble in history. Low interest rates led to lower mortgage payments, so more people bought homes. As more houses were sold, housing prices kept rising.
It's always been a policy of the government to give people what's been called the American dream, and that's the dream of individual home ownership. It's a problem because not everyone can afford home ownership. It was a particular problem during the housing bubble because banks were willing to finance people in big homes with big mortgages that they could not pay.
Banks and mortgage companies started writing more loans to people who would not normally qualify for a mortgage. These loans were called subprime mortgages. Before 2004, subprime mortgages made up less than 10% of all mortgages. After 2004, they doubled to 20%, where they remained through 2006, the peak of the bubble.
A bank looks for the value, of course, in the property. The property is its ultimate source of repayment if the borrower cannot pay. The bank will also look to the borrower in terms of his income and his ability to repay the loan. Many of the banks did count on an increase in the value, and they relied on the housing stock to continue to move up. All of the criteria that years ago was used to verify the repayment of the mortgage, that was all gone now.
The number of mortgages being written was only part of the problem. Bad mortgages became an international crisis because of what happened to those mortgages after they were written. For many years, mortgages represented a relationship between a borrower and a lender. The homeowner paid their mortgage directly to their local lender, who made the loan. So the lender made sure the homeowner could pay them back. Today, lenders sell their mortgages to investment banks, who bundle them into securities that they can sell to investors on the open market. These are called mortgage-backed securities. Mortgage-backed securities have been traded since the 1980s. At first, they were safe because only low-risk mortgages were bundled into these securities. As the market for MBSs grew, riskier loans, such as subprime mortgages, were bundled into MBSs. Investment banks actually preferred subprime loans because they carried higher interest rates than prime loans. Lenders became more willing to write risky mortgages because they were selling them to the investment banks so they wouldn't be responsible for the risk. Investment banks didn't carry the risk either because they were selling the loans to investors in the form of MBSs.
Because these securities have been bundled and pooled and sold off in different pieces to different kinds of investors, it's very difficult to know where that risk is. Is it with insurance companies who may invest in these? Is it with banks? Is it with Wall Street? Is it with Main Street investors who simply invest in Wall Street securities?
Investors often depended on rating agencies such as Moody's and Standard & Poor's for advice on safe investments. AAA ratings are the safest. Between 2000 and 2006, the number of AAA ratings exploded. MBSs were rated AAA, even when they included subprime mortgages. As the quality of mortgages bundled into MBSs went down, the ratings for those investments should have gone down too. They didn't. The investment banks that were selling mortgage-backed securities were regulated by a government agency called the Securities and Exchange Commission. In the 2000s, these firms started asking the SEC to reduce its limits on leverage. Leverage is the difference between the money a bank has on hand and the money a bank borrows to cover its investments. The more a bank borrows, the higher its leverage and the bigger the risk that, if their investments fail, they fail. In 2004, the SEC relaxed limits on leverage, allowing banks to increase the amount of money they could borrow. Essentially, banks were allowed to take on as much risk as they liked. By 2007, the 5 largest investment banks increased their financial leverage to a huge degree. The situation was ripe for a financial disaster.
The reason they took this leap of faith is because they thought the housing prices were going to continue to go up. And this was a good source of income for many of the banks.
In 2007, the housing bubble burst. Faced with a growing recession, many homeowners were unable to pay their mortgages. Those with subprime mortgages were hit especially hard. The number of foreclosures in 2007 was 79% higher than in 2006.
Housing bubbles always burst. Economic bubbles always burst. They can't last forever. And they don't last forever. Every time we have had economic prosperity, we ultimately have a recession. Sometimes, in terrible times, we have had depressions.
As housing prices fell, many homeowners found themselves underwater, meaning their house was worth less than the money they owed on it. They no longer felt a financial incentive to pay their mortgages, so they defaulted. The value of the MBSs dropped as the value of the assets they were based on fell. Suddenly, investment banks were stuck with hundreds of billions of dollars in mortgages they could no longer bundle and sell. Investors who had bought those securities were left holding worthless investments they had thought were safe. In March 2008, Bear Stearns, a large investment bank, went broke. J.P. Morgan Chase acquired the bank for pennies on the dollar. The Federal Reserve guaranteed the sale with up to $30 billion in emergency funds. Bear Stearns had been given a solid rating by the ratings agencies a month before it went bankrupt. In September, Lehman Brothers, another investment bank, announced losses of $3.2 billion. Its stock price dropped to literally nothing. Other major financial institutions consolidated or failed outright. These firms collapsed because their debt was much higher than the value of their assets. This had been made possible when the SEC relaxed leverage limits in 2004. Many countries and international companies had invested in the U.S. housing market through mortgage-backed securities. When the bottom fell out of that market, foreign markets collapsed as well. The crisis went global. The U.S. government was faced with a paralyzed financial system. On September 18th, the Secretary of the Treasury and the Chairman of the Federal Reserve asked Congress to pass a $700 billion emergency bailout of the banks. Chairman Ben Bernanke told legislators, "If we don't do this, we may not have an economy on Monday." Congress quickly created the Troubled Asset Relief Program, or TARP. This was a program to buy toxic assets, such as MBSs, from banks to keep them from failing.
TARP was a very, very controversial program. It was obviously a bailout of the banking industry, or perceived by many people to be a bailout of the banking industry. My personal belief is that TARP was absolutely necessary at the time. There was a huge potential crisis of confidence globally about the ability of the American banking system to stay intact and to survive. I believe without the very, very prompt action by the government in providing TARP funds to the banking system, we would have had a much more severe problem than we have today.
In 2009, Congress passed an $800 billion economic stimulus package, a blend of tax cuts and increased government spending that was intended to reduce unemployment and provide a significant boost to the crippled economy. Recently, the Federal Reserve lowered interest rates to zero and pledged to keep them there for 2 years to encourage businesses to borrow money, which would lead to new jobs. These efforts to grow the economy have had limited success. The financial crisis of the late 2000s was the largest since the Great Depression of the 1930s. In the fall of 2011, unemployment hovered around 9%. Many businesses failed, consumer wealth plummeted, international trade declined, and some foreign governments came close to collapsing financially. More than 4 million people lost their homes, and that number continues to climb. In 2010, Congress passed the Dodd-Frank Act, which increased regulation of Wall Street and sought to reduce risk and restore confidence in the financial system. But many people believe that more regulation will freeze credit as banks become afraid to lend. The long-term effects of the crisis remain unknown.
It was once said that people who forget history are doomed to repeat it. That's a very important lesson to be learned here. A great many mistakes were made in a great many places: government, banking industry, Wall Street, and probably Main Street as well. I fear that if we don't remember the lessons that we learned here during the past few years, that we might be doomed to repeat them. It is very important for the health of this country, our banking industry, the nation as a whole, our economic stability, for people to remember what happened here and not let it happen again.